Hey everyone, thanks for joining us today. I'm Doug Bennett, Acting Director of the New York Tech Alliance. And in a few minutes, Paul Ellis, Managing Partner at Paul Ellis Law Group, will begin today's event and introduce our esteemed panel. Beforehand, I have a few items to share with you. Please note that we record our events to share the experience with those unable to attend. Liberty, next slide. Recordings are posted on NYTA's YouTube channel. Next slide. There. To view this and past recordings, you can visit youtube.com/NYTech Alliance. For anyone joining us for the first time, the New York Tech Alliance is a nonprofit serving the New York tech community. At the core of our mission, we drive access, equity, and inclusion to make the New York tech ecosystem the most diverse and dynamic in the world. To learn more about us and how to engage, you can visit our website at nytech.org. Thanks to our annual sponsors who help make events like this one possible. Each has a presence on our website. You can learn more about them and how they support our community by going to nytech.org/sponsors. Our next upcoming event is our meetup on Monday, March 13. We'll be at Northwestern Mutual's fantastic event space on the 31st floor of 200 Liberty Street, across from the World Trade Center. The theme for the meetup will be innovations related to assistive tech. And in the coming weeks, we'll announce the demo companies and presenters who are working on transformative technologies in the areas of sight, voice, hearing, and mobility. You can learn more by going to the NYTA event page, nytech.org/our_events. And last, we love and welcome support to help us produce and deliver our programming. 3 ways you can help include add a donation when you RSVP to one of our events, become an individual or corporate member of the New York Tech Alliance, and simply make a small donation. And with that, I'd like to introduce Paul Ellis, again, Managing Partner at Paul Ellis Law Group. Hey, Paul, I'll hand things off to you. Thanks for being with us today and organizing a great discussion and panel.
Great. Doug, thank you very much. Thanks for the intro and welcome everyone. It's great to have such a good turnout for this event. This is really a great topic, actually an annual event that we have. So again, my name is Paul Ellis. I am a board member here at New York Tech Alliance. I run this series of events on legal issues for startup companies and founders, and I also run a law firm I'll talk about in just a minute. So for those who are regulars for this series, you'll know this is a number of events we have for tech founders. Other topics have included angel finance, structuring a venture capital round, preparing for an acquisition, entering the US market from abroad, and investor pitching. So a variety of topics that are of use to founders and startup companies. All of our events, or at least most of our events, are recorded and are available on the Tech Alliance YouTube channel, as well as on the resources page of my firm's website. There's a lot of great content with great panelists, so I'd urge you to take a look at some of those videos. Before we jump in today, we're just going to go around the room in terms of introductions. We have a great panel today. We have Jonathan Bresler, Managing Partner at EJF Capital. Jonathan also happens to be one of my clients, so we have done all sorts of venture deals over the last few years together. We have our own Joy Marcus, co-founder and general partner of the 98. Joy is also an active angel investor, and she's a board member here at Tech Alliance, so we're really pleased to have her. And then we have my partner in crime, Alan Wink. Alan and I have done all sorts of these webinars together. Alan is the managing director of capital markets at EisnerAmper. He has really deep expertise in the venture space, so we're really pleased to have him here today as well. So anyway, by way of introduction, so again, Paul Ellis, managing partner of the Paul Ellis Law Group. We are a 10-lawyer firm here in Midtown Manhattan. We do a lot of work with startup companies and small and mid-sized tech and tech-enabled companies. Our clients are looking to us for cost-effective, efficient solutions to their legal issues so they can focus on growing their businesses. In addition to venture and angel finance, we really handle the life cycle of issues facing startup companies, including formation, protecting intellectual property, preparing employment agreements and equity plans, general operations, and M&A and other types of exits. Our lawyers all come out of top law firms and top law schools. So that gives us the ability to really provide sophisticated expertise with the more personalized attention and cost structure of a boutique. Anyone who would like to speak with me, my contact information is here on the slide, including my Calendly link. Feel free to go there and set up a time to speak over the next few days or as you wish. With that, I will turn it over to Jonathan.
Thanks, Paul, and thank you all for the opportunity to join you today. I'm excited for the discussion. As Paul mentioned, I'm Jonathan Bresler. I'm the managing partner of EJF Ventures. EJF Ventures is an investment vehicle that is part of a broader investment manager known as EJF Capital. EJF Capital is a Washington, D.C. area-based financials-focused investment firm. We manage about $4.5 billion on the active side, as well as an additional $4 billion or so in structured credit-related investments through a wholly owned CDO manager. Our investment mandate is early-stage technology companies focused in two areas of financial technology. The first is blockchain technologies, and the second is bank tech and wealth management and capital markets technologies. Our vehicle is also a quasi-strategic investor in many cases, as we have nearly 20 small and medium-sized banks as limited partners for our fund. So we can be strategic in a variety of different avenues for our early stage companies.
Jonathan, thank you very much. Joy?
Hi, I'm Joy Marcus. Nice to meet everyone. I do really three things in my career. The most relevant to this discussion today is that I recently raised a fund called the 98, which is directed at investing in women-led technology-driven companies. So women at the top of the cap table in operating roles does not necessarily need to be the founder, but needs to be one of the first three positions on the cap table as an operator. That's our cutoff. And has to be a technology-driven business. We don't invest in pure consumer things like retail stores, which we get a lot of actually, because a lot of women do that. So we don't do that. Just putting it out there. We don't do that. We invest at the seed and early A stage. So a typical investment for us would be in a company that's generating somewhere between $500,000 and $1 million in ARR. We just closed the fund in the second half of 2022. We've made our first three investments. They're all in SaaS platforms run by women technologists. Just so happens all of whom went to Princeton University, which is not our focus. It just happened. It's where our network happens to be. So we're delighted to accept applications from others as well. I also teach at Princeton University in the Keller Center, which is part of the engineering school. I teach an introduction to entrepreneurship class, and I also sit on several boards, including a public board, publicly listed NASDAQ listed company called Perion, which is an ad tech company.
Joy, thank you very much. Alan?
Paul, thank you once again for including me on this panel. I really like doing this event every year. My name is Alan Wink. I'm the managing director of capital markets for EisnerAmper. EisnerAmper is a global accounting and advisory firm headquartered in New York. We have about 3,600 accountants across the US and 6 international offices. Ironically, EisnerAmper actually is a private equity backed company. We took on a private equity investor in August of 2021 by the name of Tower Brook Partners, which is based in New York and London. So we understand the private equity and the venture capital space very well, since we're actually owned by a private equity firm. The firm has been practicing in the tech and life science areas for about 22 years. I was actually one of the people who helped form our tech practice about 20 years ago. So we've been working with early to late stage tech companies for a long time, and certainly understand the issues that you face in growing and scaling your businesses every day. My particular areas of expertise as the managing director of capital markets are capital formation, corporate finance, merger acquisitions, divestitures, strategic alliances, joint ventures, et cetera, and also helping clients to build and execute upon growth strategies for their businesses. And Paul, once again, thanks again for including me today.
Thank you, Alan. And again, thanks to all the panelists. Really great to have you all. All right, so let's jump into our content. We're going to try to do Q&A a little bit as we go. You can put your questions into the chat, and we will get to them as many of them as we can. I can't promise we'll get to all of them. So again, our topic today is our VC update 2023, strategies for VC financing in the current climate. So what are we going to talk about today? Well, we're going to start with where is the market at, current status and outlook, and Alan is going to talk us through some numbers. So basically, as you see, we have 4 general topic areas. Then we're going to talk about advice for founders on connecting with VCs most likely to invest. That is, how do you identify those VCs who are currently active, and how do you connect with them? Then we're going to talk about changes in investment criteria, deal terms, and process. So as a result of what's going on in the market, and as we know, there is a lot going on in the market, what does that mean? Like, how are VCs changing, what they're looking for in companies, what kind of deal terms they're offering, what their process is? How do you as founders respond to that? And finally, we're going to talk for a bit about issues in connection with diversity and startup VC activity. That is to say, given that there are underrepresented groups that are the most affected when there's a downturn in the market, how do founders who are women, of color, disabled, LGBTQ plus, what are the opportunities for you all, and how do you sort of overcome the obstacles that you already have? So with that, we are going to go to go back a couple of slides to our stats on the market. And Alan, I will turn it over to you.
I guess you could look at the VC market in a number of ways, but I think people would argue with you if you really said anything but the fact that the VC market has been really resilient the last couple of years. And the VC market has been faced with rising interest rates, volatility in the public markets for tech stocks, and really global uncertainty. And with all that being said, the VC market still had its second best year in the last 10 in 2022. It's tough to compare. 2021 was a record-setting year in venture capital investment, so anything compared to 21 was going to be a down year. But still, 22 was a good year, second best year in the last 10. Unfortunately, if you look at trends, in every quarter of 2022, VC investment went down quarter to quarter. So it looked like an upside down hockey stick. Is that a tipping point of what the future is going to hold? I think we'll learn more in the first couple of quarters of 2023. 2022 was a really tough year for exits for VC-backed companies. There were only $71 billion of VC-backed exits compared to $750 billion in the prior year. the IPO market came to a grinding halt. It was a 5-year low in terms of, IPO activity for VC-backed companies. And I think, the SPAC market, almost came to a halt. And the fact is that a lot of SPACs had to return capital to investors. You look at the fundraising side, 2022 was a record year for VC funds raising capital. They raised $163 billion. And I think we all thought that was really a great year until Q4 22 numbers came out, and it was the lowest amount of capital raised in a quarter by VC funds in the last 9 years. So are we going to see a trend going the other way? Once again, let's keep our eye on, VC activity in the first 6 months of 2023. Valuations, I think valuations for seed and early stage companies have certainly been holding strong, even maybe increasing a little bit. I think later stage companies are starting to see a decline in valuations, and that could be directly tied to what's going on in the public markets for public technology companies. And I think the last point I want to make, and be interesting to hear from the other panelists, I think we're going to see down rounds become a more common occurrence in 2023 than what we've seen in the past couple of years. But I think that's sort of a good synopsis of where the VC market is right now.
Alan, thank you for that. Joy, I'd love to hear your comments in terms of your view as to where the market is now and what you're expecting over the next months, maybe the next year or so.
I mean, look, Alan presented a lot of irrefutable data. It kind of is what the data is what it is. It's not going to be, I think, an easy year, the easiest year to raise money for startups. It's not an easy year to raise money for funds either. I mean, PitchBook just released a report, I think today, talking about how difficult it is for first-time managers to raise money, how difficult it is even for very large funds to raise follow-on funds. So I think we're in a climate where money is, I don't want to say scarce, but it's harder to come by for all parties involved, everyone involved. So, I'm a first-time manager, and we successfully raised, we closed and funded right as the market was turning, and we're super happy that we did. And we have, we always said, oh, maybe we'll take another couple million. We haven't really even tried to do that because we felt like we'd be spinning our wheels a little bit. Let's just get our investments going. So that's my personal perspective on what's going on. In terms of what I've seen in deals. So again, I invest at the seed and early A level. So the valuations, have been, we all see seed deals that are in excess of $20 million and we'll call themselves seed deals. We all see, A rounds that are only $20 million. I think the terms are very, very, very fluid in this industry. We've looked at 400 companies in the last 6 months and invested in 3. So that says a lot, I think. We are extremely cautious. We're extremely valuation sensitive right now in a way that perhaps we might not have been, but for this climate. So I think there's that. I think there's a lot of valuation sensitivity. We have not participated in a down round. And none of those 3 have been down round. We've seen down rounds. We've chosen not to participate. Have we seen more down? We're new. So can I say I've seen more down rounds than I did last year? I can't say that. But I can, sort of see what's going on in the market. And I think you are seeing a little bit of that. I think, my advice, I sit on a number of boards. In all the cases, even in the small, I sit on a couple of smaller, sort of VC-backed company boards. Everyone has been able to raise money. No one has not raised money. So that's kind of encouraging. And in no case has any of those that I've seen been a down round, but I do hear about down rounds all the time. I do. So I think extremely valuation sensitive, a market that's, just extremely valuation sensitive, where money is scarce. The advice as a board member now is to have, plan A, plan B, plan C. Plan A is, like all bets are off, no hiring, maybe skim some off the top of the company, get your, costs really, really under control. Plan B is you're able to raise a modest amount, maybe not as much as you thought you would raise. So put in some, put some dollars towards growth, but, be careful about it. And plan C is this particular value proposition that your company offers is so compelling that even in a harsher market, you're going to raise capital. And I can say that literally all three companies, they're all SaaS platforms, were oversubscribed rounds that we participated in. So there is capital. There is capital out there. So all is not lost.
Joy, thank you for that. JB?
Yeah, look, I don't have a tremendous amount to add. Alan and Joy did a great job summarizing the markets out there. I would only say, to echo Joy's point, that there is capital out there. We are actively deploying capital today. We are being extremely judicious given the opportunity cost of liquidity today from a variety of different angles. With that being said, strong businesses and sane founders will have the ability to get through these challenging times without giving up too much. The one thing I would say is, these are not the environments to get greedy. Raise what you need to raise, not what you want to raise, and do so under terms that you feel like you can manage the business appropriately with appropriate upside. But if you go into conversations with a greedy mentality, I can just say from my perspective over the last couple of months, it shortens the conversation really quickly, and we tend to pass maybe even prematurely if the valuation expectations are just not in line with the reality of the markets today. So maybe I'm jumping ahead a bit, but I would just throw that out there.
That's great, JB. Thank you for that. Let's go on to the next topic, and we'll dig in a little bit on some of the details. Could we get the next slide, please? Great. So now we're going to talk about. So we've set the stage, which is, the market is tighter than it was, but there's money out there, maybe a little bit harder to raise, and so the question now is, how to go about that. And I think there are a few issues there, and an important one is recognizing that investors are being a little bit more cautious. How do you identify those investors who are actively investing now? How do you connect with them in order to because not everyone is going to be an investor that's active. So with that, why don't we start with Joy?
I would say do your homework. I think investors, particularly those who are breaking, like I'm a startup investor, if you will, right? Like where I didn't go through my background, but I have been a venture partner at 2 large venture firms and also sold a couple of companies. So I'm not new to the venture world, but this is my first time as a fund manager. I am very surprised at some of the folks that approach us. We are very, very clear on our website. I mean, it's so easy to find us, and we are so clear about what we invest in and particularly who we invest in. I mean, we are a gender lensed fund, full stop. We are. So, I would say really do your homework. And we are a gender lens fund that doesn't do a lot of consumer, almost any consumer, nothing without a strong tech backbone to it. And we're super clear about that. So I think the first thing you need to do is do your homework. And there's a lot of publicly available data. There's, even the sliver, even if you don't want to pay PitchBook's enormous fees, there's a layer of PitchBook that is for free. There's a layer of Crunchbase that is for free that you can use. They're tremendous resources and just basic data on the firms are described, websites, lists. There's so much publicly available data. Do your homework. You'll figure out who's dormant, who's investing. You can see by their last investments. You can figure out what their focus is. And you can even probably figure out, in the case of a larger firm, who the right partner is to approach. And doing that homework, it gives comfort to the VC, because they're like, okay, if they're willing to be so careful about that, that's how they're running their business, right? They're taking care in everything they do. So it's kind of like your first thing to do right in the eyes of a VC is know who you're talking to when you make the approach. And the other thing I'm going to say, which is very obvious, is personal connections trump everything. So, VCs get a ton of, I'm a new VC, we get a ton of inbound, just to our, info at. And we do go through those. We do, like, once a week, an intern looks at them, sees what's interesting. We don't ignore them, but a personal introduction of any kind goes much, much further. So I think that's pretty obvious, but it needs to be said.
Joy, thank you for that. JB?
Yeah, look, I mean, I would I would reiterate everything that Joy just said and then add a few other things. Many venture firms, most in fact, publish a list or list out their portfolio companies on their websites. What I would suggest that all companies do is think about the business that they are forming, the business that they have, and think about complementary companies, not competitive companies, but complementary companies that could feed into an ecosystem. In most scenarios, that exists. And if you can identify venture firms that have funded complementary businesses, and you go into the pitch saying, hey, founder, or hey, venture fund XYZ, I see that you have an investment in company ABC. We think we could work in a highly complementary way with this company. That begins to get the wheels spinning a lot quicker. And that does require founders to do additional work. And it is not necessarily the easiest task, but I'd say your success rate, your hit rate, and just the way you come across and your credibility will be elevated immediately. And that, again, is just to reiterate everything that Joy said already. The personal relationships, they matter. Screening the venture firms for fit from really every different angle is essential. We get a ton of different pitches for things that are not within our bailiwick, but for those that are, and we can think about them in the context of our portfolio writ large, even in a challenging environment today, that becomes a much more palatable conversation from an investment committee perspective, from a valuation perspective. So that's just one area where I would tell potential companies to hone in on.
JB, thanks. Alan, your thoughts?
I think Joy and Jonathan did a great job of summarizing here. I just want to make a couple of points, just to talk about the warm introductions. And we all have friends that are attorneys, accountants, investment bankers who have relationships with partners in VC funds. That's the kind of introduction you want. You want to get to the top of the pile. Don't want to be another statistic for the VC fund. I just want to talk about one thing that Jonathan mentioned, and that was raising the right amount of money. And I agree with Jonathan wholeheartedly that it's not the amount of money you want, it's the amount of money that you need. And make sure you understand how you're going to deploy that capital and what milestones and benchmarks it's going to allow you to achieve. I think that's really important, because that goes into the valuation discussion you might have with an investor. And it's you're drawing a line in the sand. You're going to raise X number of dollars, and it's going to take me this far. And I think a VC is going to spend a lot of time understanding that.
Alan, thanks for that. I mean, I'd underscore a couple of things. I mean, there was some conversation about diligence, and I always tell my clients, in the diligence process, they should try to talk to the portfolio companies. Go out and speak to the CEO and the co-founders of companies where the investors they're considering have invested, to find out, because the investor that you're considering, you want to bring onto your cap table, they're going to have a seat at the board table. They're going to be with you for years to come. So it's not just money. You want to know how an investor is to work with. And especially how an investor is to work with, not just in the good times, but the bad times. It's always easy to make things work when everything's going fine, but inevitably there are going to be problems that are going to come up. And you want to know how is an investor to work with when there are difficulties. Are they constructive? Are they flexible? Are they problem solvers? So those are all important factors. The other thing that was mentioned is introductions. And I should say, introductions can come from any number of, it can come from your network of co-founders. It can come from your lawyer or accountant. There are, through your network, if you start sort of poking around on LinkedIn, in almost all cases, you're only going to be 1 or 2 degrees removed from any VC in New York City, for example, that you want to reach out to. And so, as Joy said, I'm glad to hear that the 98 looks at everything that comes over the transom. I'm not sure that everybody does, and for sure they don't look at it as closely as something that has come in through a referral, because it's really it's a sieve. If you're coming in from someone who the VC knows and trusts, like the first level of diligence on the company has already been done, in a sense, at a high level. So anyway, with that,
Hey, Paul, to add one other thing to that, and
please.
especially if you have a good relationship, to get into a VC, there's an adage in venture capital. It's sometimes you ask for money, you get advice. Sometimes when you ask for advice, you get money. So, if you have that good relationship, don't hesitate to ask a VC for advice, because you never know what might happen.
Right. I also want to follow up on one thing. So this VC company relationship is really kind of like a marriage. I teach this in my class at Princeton, and it's a very long-term thing. Usually companies don't take a good couple of years to exit or die or whatever. It just takes a while, right? The process. So VCs are looking at how you're conducting yourself also. So you're evaluating them, as Paul said, which you must do. Is this the person I want to get married to? Is this the firm I want to get married to? VCs are doing the same thing on the other side. They're like, how do they conduct themselves in meetings? How do they, they have a great business model, but is this a person I want to get tied to for a long period of time? There is a little bit of that. Of course, VCs have this added thing of being able to change management. If they have that power, something you should also be aware of. But for the most part, we don't want to have to do that. We want to be married. And so we're looking the same way. We're looking at you like, okay, is this someone I trust? Is this someone I can work with? This is someone who's going to bring honest numbers to a meeting. Is this someone who's going to approach me with problems at the right time? That kind of thing.
That's so important. Just one last thought on that. There's when you're pitching, for example, every company has like certain things that are really going for it and problems you need to solve. There are things that you need to figure out, and it's really important to be upfront about the risks, upfront about the issues, upfront about the things that you need to figure out in order to turn your company into a home run, because the investors will for sure see it. And if they recognize that you're being realistic and upfront about what you need to figure out in order to thrive and to really hit a home run, that will enhance your credibility and in their eyes as someone that they can work with, that will be a good partner going forward. So,
and Paul, I think you hear a lot of VCs when they talk about founders, and I like to hear Joy and Jonathan's comment on this, is that, are the founders coachable? Will they take our advice? Will they take our guidance? And I've heard that that's very important. You want to have founders that are coachable.
Absolutely. Joy, Jonathan, should I move on, or you guys have anything to add right now?
No, I think this was fulsome.
All right, great. Let's go to the next slide, topic 3. So we've touched a little bit on this, but given that we've got a slowdown, what is that? What are the implications of that? So what are investors, how are you changing your process? How are you, what are you looking at now a little bit differently? And what sort of deal terms are you, in what ways may the deal terms that you're offering differing from what you were doing a year ago? Why don't we start with JB?
Sure. So, this is a very interesting and very fluid environment. We very rapidly pivoted from an environment where founders had substantially more leverage, typically in a negotiation, to the inverse. And going into a conversation knowing that in the vast majority of circumstances, the venture fund or whoever you're pitching likely has the upper hand in negotiation because the markets are cool. Going in with a practical sense of what you're looking for is even more essential. We touched on that earlier. But as far as investment criteria, the way I would phrase it, and this is a little bit blunt, but I think it's important. I have seen a ton of really good ideas. I've met a lot of really smart people. I have found very few businesses. So at the top of the house, very first thing you need to do is figure out what your business is, how you intend to make money, how you intend to grow, and how you intend to monetize your idea, your product, your technology, whatever it might be. That sounds rudimentary, but the vast majority of founders lose sight of that really important distinction. And then you can think about deal terms and process and all that other stuff. As far as deal terms and process, you just really need to have a good handle on when you're going to be cash flow neutral and when you're going to be cash flow positive. The return to normalcy from the investor perspective on what a business needs to do, i.e. generate revenue and at a point become accretive to equity, has gotten much more practical over the last 6 to 12 months. Have a very clear sense of what that might look like. Then you can dive into operating margins and burn rates and all of the other stuff that I'm sure my co-panelists will dive into in more detail, but really start from what really matters. What's your business and what are the levers and how can you best express those in the appropriate structure? So that's what I would start with.
JB, thanks for that. Joy?
Yeah, I would agree with everything he said. I mean, understanding the levers of your business and how you scale and eventually get to profitability, at least having a vision for that coming in, even if you're at the early stage, is very important and unbelievably often ignored. So that's kind of like, check that box. That should be obvious, I hope, and easy to everyone, but really do that, especially in this environment where people are less likely to fund, oh, we're just going to, growth at all costs, we'll figure out the business model later. That I think hasn't worked for a while. It certainly isn't working anymore. I think what I'm not seeing yet, and I'd love to hear the other panelists on this, are really draconian investment terms, like, double sort of participating preferred, kind of double dipping on stock preferences, that kind of thing, that I have not seen before. And we don't need, so I see a lot of deal sheets. And I'd love to hear, because that would be a little bit of a change, and that I would say that's kind of bound to come if the market continues in this direction. And I see some nods, so maybe it's already happening, and I have not seen that in the deals I've been working on. So it's I feel like it's more, whereas 6-7 months ago, even the founders were really in the driver's seat. I think there's much more of an equilibrium, if not, sort of the pendulum is now shifting, maybe more rapidly to the investor side. What does come with that are not only down rounds, but, like what I view as somewhat draconian, as having been a founder a couple of times, somewhat draconian investment terms that I think you have to just know about, know that they may exist, know what they mean, have a good lawyer who can help you through those. But I'd love to hear the other panelists on, kind of whether they're seeing that shift. I have personally not seen that. What I have seen is lower valuations, slower time to invest, much more emphasis on the business model and, even, basics, unit economics, everything that, you sometimes didn't get into at the seed round, you are getting into now. But I haven't seen really draconian terms. So I'd actually love to hear. I'm asking my panelists a question.
So before we turn that one over to Alan, I'm gonna focus on that question a little bit, because that was the next question, actually, Joy.
Oh, sorry. I'm sorry.
No, this is perfect. It's a great segue.
Okay.
Because yeah, that is something I am seeing. I'm seeing more what we call structured deals. So instead of, I mean, it's been years since up until this year, since I've done anything, whether representing the venture, the VC, or the company, done anything other than a one-time liquidation preference or non-participating preferred. I mean, this is stuff that I did earlier in my career. Haven't seen it for years. The last 6 months, I'm starting to see it. And there is a tension, there's on the one hand, you can have a structured deal where the deal terms are more investor favorable, or you can go with a down round, or both. And so, I'd be interested to, like Joy, I'm interested to see what the rest of the panel is seeing in that as well. Alan, you want to address it?
I haven't seen a lot of onerous investor terms recently. Maybe we've seen more of disproportionate voting rights given to the capital coming into a company. Certainly seen maybe stronger anti-dilution provisions coming into situations. I think as Joy said correctly, I think we're seeing it. The trend now, it's not about growth, but show me a clear path to profitability. And I think that's what's become important in the investor's eyes. How are you going to make money and how much cash are you going to burn up until that point? I'm also starting to see more common staged investments where they're investing in stages based upon the achievement of milestones. So, but getting back to your earlier point, Paul, I don't think the terms are any more onerous than I've seen in the last 3 or 4 years.
Okay, great. Thanks, Alan. JB, your thoughts?
Yeah, look, I'd say it's a mixed bag. We've participated in a couple of structured investments over the last 6 months or so. And we did one deal with a 1.5x liquidation preference. We've done deals that have ratchets or essentially free warrants if certain milestones aren't met, where we are, investing at a multiple of revenue. And if those revenue multiples are breached by some degree of variance, we get compensated on the negative side. And then, we are looking at least 2 down rounds in pretty meaningful earnest. These are deals that were essentially seed funded by a consortium of financial institutions where they just assigned a valuation at the inception of the company with little deliberation. And, now a year and a half, 2-3 years later, and, they have to be evaluated on the business merits of the investment today. It's just much different. So, we are seeing substantially more than we were, 4 to 6 months ago. And I expect it to accelerate.
Thank you. Thanks for that, JB. I want to go to a question that we got from one of the participants. What sectors do you all see as especially attractive over the coming months? Why don't we start with Joy?
Investors are lemmings, and to a certain degree. I was saying in my breakout group that my partner and I really try to stay away from it. We have like an investment thesis that is different than this, which I'll tell people in a second. But anything generative, if I'm saying that word correctly, AI. I mean, we had a deal with like a very unattractive deal in the AI space that we ultimately passed on because it was so unattractive to us as investors. Like it just seemed untenable, but it got funded. It was, female run AI company. It's like an investor's dream, right? So we get that, but we weren't willing to go along with the valuation and the terms. So I think anything that is like, that's obviously very, very buzzy right now. And again, I do think investors are lemmings. I think, we're sticking to our guns on, industries that are easily disrupted that are extremely inefficient, run on Excel spreadsheets, easily disrupted by a good working piece of SaaS. We invest in like workhorse companies like that. That's basically the thesis of our first fund. And we're just going to do that again. And we've done it 3 times. We hope to do it 12 times in different sectors. So there are some firms that, can afford to sort of go with the flow a little bit more and invest in, some sectors that are considered hot. Other than AI, and particularly not even just regular old AI anymore, generative AI. I have trouble with that word. I'm not seeing anything that I would say is like, I'll tell you what I'm seeing a lot of. I don't know if it's hot. I'm seeing a lot of anything to do with human capital. Everybody's, sort of pondering the effects of COVID still on the workplace. We don't have a ton of data post-COVID, in the post-COVID world yet to work off of. And so everybody's looking for solutions around, this issue of in-office, out-of-office, work-life balance, Again, that pendulum is swinging because until maybe 6 months ago, particularly in tech, the employees were in the driver's seat. Now the employers, seem to have a little more leverage. So maybe that well of human resource spending will actually dry up. But I cannot tell you how many companies like that I have seen that are trying to solve for those kind of problems. So one that's hot. And one that's just everybody's trying to do. I don't know if that makes it hot or not, but everybody's trying to do. I'll give you those 2.
Got it. Thanks, Joy. Alan, thoughts?
I think there are 3 areas that I'm seeing, capital being deployed in, and probably 3 areas that have, incredibly large potential markets. And the first is certainly health tech. When you think about how much of our GDP is, towards health and wellness, that's an area that's attracting a lot of venture capital today. I think the area of sports tech with, online betting and NILs and things like that are beginning to attract a lot of capital. And finally, another area that has large potential markets is education technology.
Yeah.
So I think those are the 3 areas that I'm seeing a lot of capital being deployed in.
Great, thanks. JB?
Yeah, so we have a fairly narrow remit for our fund, given our specialty in financial services. And much of what we invest in at the top of the house at EJF Capital is predicated on regulatory change for the most part. So trying to anticipate new regulations or evolving regulations at the global level for financial services. So, where that's most obviously expressed is in blockchain related technologies, technologies that harness distributed ledger solutions for a wide variety of highly antiquated problems. And financial services is woefully underdeveloped from a tech perspective. So there's more than enough to do. That's very different than crypto, I would say. So that's where we're focusing a lot of our efforts. That's where we're seeing a lot of compelling opportunities. But fintech writ large is still particularly balance sheet light fintech that has B2B continuity. There's a ton to do because for the most part, there's been little innovation for 30 years.
Yeah. I want to agree vehemently on the sectors, because we also do see a lot of education tech, I think, as well coming through. And on the fintech sector, I mean, our third investment is in a fintech exactly as you described, just improving current processes.
Yeah.
Which are woeful, really woeful.
Pitiful.
Yeah. Yeah.
Right.
Sort of unbelievable, actually.
Thank you both. Can we go to our 4th slide, our 4th topic? with the subject now, diversity, as I've, it's almost inevitable that when there is a decline in venture activity, underrepresented founders are disproportionately affected in a situation where they're already disproportionately represented. So the question is, what, in a challenging market, what do underrepresented founders do to get a leg up? Why don't we start with you, Joy?
So this is my, whole reason for being at the moment. So I have a lot to say about it. I don't want to dominate the conversation here. So my partner and I were sort of swimming along in our careers, and we've known each other for 40 years. We went to college together, and we basically observed that 98% of venture capital, the name the 98 derives from this, 98% of venture capital does not go to all female teams. And you increase your chances, sorry, my dog just ran in, you increase your chances, a little bit if there is a male co-founder, but not that much. Still 80% goes to all male teams. And that's in dollar amounts, not number of deals, just straight up dollar amounts. Because deal number is a little bit different because smaller deals go to women. Bunch of smaller deals go to women, just in like size, total size of check. And that number has been stagnant for 10 years, including 2022. I think it's appalling. And I think, so I'll shut up in a second. I'll say what we're going to do about it. But like, it's appalling, not just because it's unfair, or it's appalling because the tech that we all live with is being developed by one kind of person, and that person is white and male. And that's not good for society, I think. So that's what motivated me to kind of like take a big risk, at my ripe old age and do this. I think it's much, much worse for anyone of color, male or female. I think the male numbers of color might be akin to the female numbers, but if you do both of color and women, it gets really bad. So we have a lot of work to do. We just have a lot of work to do on the venture side. Like, we have to do a better job. There needs to be more investors that, look like the population than there are right now. Only something like 15% of venture funders are women, right? People who actually make investment decisions at firms. The firms have all gone through a big hiring process of very junior women at this point that they're building up through their ranks. So hopefully that will change. But right now at the investment table, it's something like 12 or 15%. So that has to change. That's a given. So what do you do now if you are in a position where you're not the kind of person that gets funded easily? One thing to do is to, look for venture investors who look like you. I mean, it's venture investing. There's a certain degree of pattern recognition to venture investing. People talk about that all the time. I don't even like the term that much, but it's true. And part of that is people who look like you. You know what to expect. So definitely, take advantage of that. And look, again, this is homework. Look at the history of the investing of the firm, where you're more likely to see a warm audience. If you're pitching, for example, like we get, the other thing that didn't come up is the hot areas, menstruation, very hot area. Like, I have seen probably 25 companies trying to solve what is a really big problem and ignored healthcare issue for women. Did I say menstruation? I meant menopause, ignored, totally ignored, right? So MENS word, sorry. So, 20 companies like in 2 months trying to solve for that. Goes into the general category of healthcare. Really hard to pitch a group of men on that. Just really hard to pitch a group of men. And I get that. We're humans, right? We're imperfect humans. So you sort of know your audience. If you're about to go in and pitch a group of men and with a product like that, be very self-aware going in, know what they don't know, put yourself in their shoes and help them be better is really what I think founders have to do. They have to help investors be better at their jobs. by, sort of being really great in presentation, but really understanding kind of their limitations as human beings right now. So that's my spiel. I'm trying to change it. I'm doing my best, one company at a time. And it's fun doing that. So hopefully we'll have some success.
Joy, thank you so much for that. Alan, we're running a bit short on time. Alan, you got about a minute on that topic.
I'm not sure there's a whole lot I can add. So I think you did a great job on that, but I do think, we're going to see improvements in the future. It's hard to pull up the Wall Street Journal on any given day and not see an article relating to diversity, equity, inclusion. So, both, institutional investors and other LPs are certainly focusing on this. Probably not as quickly as a lot of people would like, but I would definitely expect to see improvement in the future. And I think, people like Joy who are starting the funds that she has started are going to have a great impact in this area.
Thanks. JB?
Yeah, look, I agree with Alan. There's a tremendous sea change afoot regarding awareness, regarding access, regarding capital availability. And within the investment community, I can say, speaking from EJF Capital more holistically, we have mandates from many of our large investors to consider DEI and ESG ramifications of our investment thesis, of our portfolio allocations. And that's really for every fund, from our hedge funds to our credit funds to our venture funds. So, from a direction of travel perspective, I do see material improvement. Now, with that being said, as I evaluate potential prospects for the fund that I manage, those considerations are certainly part of the equation, but they don't even come close to trumping the considerations that we highlighted earlier. What's your business? How do you intend to capitalize on a problem? Relying on, any other kind of consideration and to try to get an audience is naive, because I do think that all of the funds that are focused in this area, Joy's and many others included, are still going to scrutinize heavily. So, I don't want that to get lost in the conversation. You have to have a tremendous command of your business, your market, and what perspectives that you can bring to the table that will be additive and unique. So that's all I would add.
JB, thanks for that. We've got about 2 minutes. That gives you each 30 seconds to final thoughts. Alan, why don't we start with you?
Great discussion. Great talking to the other two panelists. I think it's going to be an interesting year for venture capital. I'm not going to say we're at a tipping point, but we actually might be. The asset class is really large right now. A lot of dry powder on the sidelines, and I think they're just being much more selective in the deals they're going to be doing this year.
Thank you. JB?
Yeah, look, I would say that, we are cautiously optimistic. These types of vehicles get evaluated on from a vintage perspective. And, we are setting ourselves up, in our opinion, to enter into a really attractive vintage cycle. And being able to, be a part of a portfolio of winners from a company's perspective gives founders a tremendous leg up in future endeavors. So, thinking about the dilution that you might have to take today in the context of your, broader career and in the broader narrative of the environment that we're all in is essential. So, we're excited, we're deploying capital, and if anyone wants to chat afterwards, you have my info.
Great. Joy, last word.
I'm a forever optimist. So, I raised a fund in this crazy market and we are deploying capital. Know your stuff when you come to speak with us, and, we'll be very, very fair.
All right. Thank you all. Let me just, some final words. This event was videoed, was recorded, and the video will be available. So be looking out for that, and feel free to distribute it to your contacts and colleagues that might find it of use. We talked a little bit about structured rounds, and we will have an upcoming event where it will be a deep dive into venture capital deal terms. What is a liquidation preference? What are the various deal terms that you're seeing, especially in this market? And we have the networking, which we're going to go back to the breakout rooms, which would hopefully function properly this time. So feel free to stay around, but you've got the contact information for all the panelists. And so certainly make a note of that. I think we got to everybody's questions. There weren't that many. But if you have any questions, feel free to reach out to any of us, either in the networking session or after. That's all I've got. Thank you to all the panelists. And thank you, Doug. We'll turn it over to you.
Thanks, Paul, Joy, John, Alan. What a great conversation, and hopefully everybody enjoyed it as well.